Okay, you
All
can go.
right. All right. All right. Well, good morning, everybody. My name's David Floyd with Aspen Trading Group, and this is my first live video session in some time here at FX Street. But I've been contributing to FX Street for probably over, oh my God, probably 15 years, maybe, well, probably about 10 years or so. I don't remember exactly when, but it's been a while. So first of all, I want to I want to thank not only Mauricio but also Adina for getting this all set up, and I appreciate everybody for attending. Um, Given that this is the first of a ongoing series that I'll be doing, I want to kind of set the tone in terms of, and obviously because of the time of the year, I want to kind of set the tone for 2016. I want to review some themes that I see, and as a result, where I might be focusing my attention, not only in the FX markets, but for those of you in here that are exclusively FX traders, I'm sure you're well aware that you need to be looking at other asset classes in order to facilitate good trades in the FX market. So I'm going to be providing a good overview of not only the S&Ps, going to be looking at gold, looking at interest rates, and of course that all factors into FX trades specifically. So I'm going to start off the session with kind of where we were in 2015, where I think we're going, and then I'm going to share some trade ideas. And then what I think I'm going to do next week is I'm going to kind of rewind it a little bit and maybe do a little bit more of a background on my overall philosophy and my trading style, so that as we do these webinars each week, or these live sessions, I should say, each week, those that have been attending each week will have a better sense of how I look at the market. And of course, that'll become more obvious over time, but it's also a good idea just to give you a good foundation right from the get-go. You can type in your questions into here, and I'll certainly address those as we go on, if it's applicable. If not, I will address them towards the end of the session. The other thing too is I did not set up my webcam for this particular live broadcast, but I will have that set up for next week so that there can be a little bit more of a kind of a human interaction, so to speak, rather than just a voice in a screen share. Obviously, we're looking at the legal mumbo jumbo right now. I'm going to get past that and move forward. So again, we're going to be talking about today is kind of the big picture. And what I mean by big picture is themes that I'm seeing in 2016 and how those ultimately translate down to making trades on a short-term / intraday basis, whatever your time frame is. I tend to focus a little bit more on multiple day trades, but I'll get to that in just a moment. For those of you that aren't familiar with myself or Aspen Trading Group, I've been doing this now for 21 years as a professional trader. I was an equity trader, day trader for a number of years. I got my start at a investment bank on their prop trading desk, but I've been managing Aspen Trading Group and the services we offer since 2001. So I've been around for a while. I've been featured on the various media outlets, be it CNBC, Bloomberg, been nominated for Technical Analyst of the Year back in 2011, and that was up against some pretty heavy hitters like the Merrill Lynch's and the Goldman Sachs's of the world. I did not win that year, but to be ranked with those people was certainly an honor. And I think the only other thing I'll say is kind of a distinguishing feature as to what I do here at Aspen Trading. I'm probably one of the few people out there that's not only doing analysis, but actually managing money based solely on that analysis, and all that information is available on my website. So we have complete transparency. So I'm putting my money, not only my money, but my clients' money, where my mouth / research forecasts are on a day-to-day, week-to-week basis. And I think that's a refreshing thing to see in this day and age, where you can oftentimes have people pop up out of nowhere and start dispensing investment wisdom, and you're not really sure kind of where it's grounded, or if it's actually working to any degree. So that being said, enough about a little bit of social proof, but it's important. I want to establish some credibility, at least up front, or at least let you know who I am. And hopefully what we discuss today and in weeks going forward is helpful for you and helps you to make money and be a more efficient trader in the markets. So I want to start off today's presentation is if you don't stand for something, you will fall for anything. And what I'm really getting at there is that, and trust me, I've made these mistakes over the years myself. No trader's immune to them, whether they're experienced or brand new out of the gate. You got to have a sense of what you're looking to do in the market on a day-to-day, week-to-week basis, because if not, especially in this day and age of having so much information available at our fingertips, it's really easy to get sidetracked. And I'll give you a good example. And it typically applies to new traders, but it can also apply to experienced traders when maybe they're in a little bit of a slump. But that scenario is as follows. You know, you're following a particular strategy. Let's call it the ABC trading breakout strategy. Again, I just made that up. And you're making a little bit of money at it. It seems to be working pretty well. And then you hit, you know, 1 or 2, maybe 3 losing trades in a row. It's pretty easy at that point in time to get a little sidetracked and go, I wonder what's happening over in that trading room where they're doing the XYZ breakout trading strategy. And you zip on over there and it's a completely different strategy, completely different mindset. And you find that that's working okay. Or maybe it's not working okay. And you're kind of like, oh, crap. ABC is not working right now. The XYZ is not working right now. And now you're kind of in the netherland. You don't really know where to go. My point in all this is that you have to find yourself a trading strategy, one that's suitable to not only your risk temperament, but also suitable to the way you like to view and research the market. And assuming that it's robust and has a positive expectancy, you need to stick with it. Yes, you'll need to make tweaks and adjustments over time because that's just the nature of markets. But losing streaks as a trader are unfortunately an all too common thing. I would say on average, you know, traders, generally speaking, if you encompass novice all the way up to professional traders, I'm guessing somewhere in the 50% win-loss ratio is probably, you know, where it is. You get the other end of the bell curve, maybe if you can get up into the 65, maybe 70% win-loss ratio. And then you get the other extreme, you know, maybe 30 or 40% win-loss ratio. But those guys and gals are making really big gains on their winners and much smaller losses on the losers, even though they're winning less than they're losing. I personally can't really deal with a strategy like that. I have a hard time knowing that I might only be right 3 out of every 10 times. That's a pretty tough pill to swallow in this day and age where immediate gratification is pretty much on offer everywhere you go. But again, you got to find what works for you and then stick to it, and stick to it religiously. And if a day or 2 or even a week goes by where you don't make a trade, so what? It doesn't matter. We're not here to trade for entertainment. We're here to trade to make money. And I think a lot of people lose sight of that. If you want to be entertained and have fun and get the endorphin rush, go to Vegas. They got free drinks there and pretty women to look at. And if you're a woman, they've got pretty guys to look at. But trading's not about that. Trading's about walking away at the end of a week or a month and going, hey, I made good decisions. My trading account grew X%. This is what it's all about. So on to the next slide. So my goals for today are pretty straightforward. I don't have an agenda in terms of indoctrinating anybody into the strategies that I employ, but I certainly want to share them with you and let you make a judgment as to whether or not that's something for you, or maybe you pick a little nugget out of here and feel as though, hey, that makes sense. I could intertwine that in with what I'm already doing and really make my overall methodology more robust. But inspire, that's the key word. Traders need to be inspired, especially in this day and age where most of us, myself included, work in an office or work from home, and you don't have a lot of interaction with other people. You want to be inspired. It's easy to kind of get into a rut. So I want to inspire you to not only forge ahead with your trading plan, or inspire you to get a little bit more details on how I trade and how I approach the market on a day-to-day basis. It doesn't matter to me, but if I can kind of get people to, at least look at something a little differently and go, wow, that could be really interesting in terms of how I trade. Fantastic. And again, stressing the importance of impulse control. I'm going to tell you right now, on average, I make 4 to 6 trades per month. Yep, I know there's a few of you out there right now are going, geez, that's not terribly exciting. Again, I don't give a crap. It's not about being exciting. It's about picking your entries and picking your exits and, pulling pips and or points if you're trading equities or options or whatever out of the market. It's not about being in the market at all times, at least not as it relates to the way I approach trading. And then again, one of the themes we're going to be talking about is I always want you to consider the big picture. And what I mean by that, I'll give you just a simple example. Let's say you're bullish the dollar. So you're looking at the dollar index and you're like, wow, really love this dollar index. It looks as though the dollar is going to continue higher into 2016, which of course is a theme that I believe will continue, and I'll get to those charts shortly. But at the same time, if you're looking to get long the euro, you've got a fundamental disagreement there. You can't possibly be bullish the dollar and bullish the euro at the same time. Now, while that's not a quote unquote big picture theme, it is a very critical component to anybody's trading strategy. You can't be trying to stick square pegs into round holes. Ask yourself and just kind of contemplate this over the next few days or the next few hours. What's your process? How do you arrive at your trades? What is the process that you go through? Do you just look at charts? Do you just look at fundamentals? Do you combine the two? Do you combine fundamental and technical analysis? And let me just pause there for a second because I got a couple of questions here. No, I've moved the slide away from the disclosures. So is anybody else only seeing the disclosure side, or does everybody now see the slide that says what's your process at the top? If you could type in what you see into the question and chat box, that would be great. I want to make sure everybody sees the right slides. Just the disclosure slide. Interesting. That's very interesting. So the slides aren't changing as I move through them. I wonder why that is. Let me do this. What I'm going to do is I'm going to turn off the screen share, then I'm going to turn it back on. I don't know if that will be the issue, but let's give it a try. Okay, let me know what you're seeing now. Does everybody see what's your process now? If so, that's good. We can continue on. Okay, cool. Yeah, I don't know what happened, but technology, you love it, hate it at the same time. So again, what's your process? Real simple. What is your process? I'm not questioning it. I'm just saying, do you know what your process is, or do you kind of trade in a manner whereby you're kind of flying by the seat of your pants? So I think it's really, really important to always have a good process in place, just like a checklist in any other job. I always use, I have a really good friend of mine here in town. He's a brain and spine neurosurgeon. Don't get much smarter and more complicated than that. And when I talk to him about his profession, I'm fascinated by it because it's just, it's way beyond my pay grade. My brain's not wired that way to be able to do stuff like that. That's something I could never do. And when I ask him about his, what he does on a day-to-day basis, it's very regimented, just like it is for trading. But just like in trading, there's always those times when he might be in the middle of an operation and he looks at something and go, huh, you know, I know the way I learned to do this in school and through residency would be to do steps A through D and then jump ahead to step L. But, you know, I've seen this before and I know I can do it this way. There's that historical, or that there's that experience. I don't want to say intuition, but I think there is also an element of that where that part takes over, and your experience and your hours upon hours of knowledge that you've taken in take over and provide a more robust framework than just simply following a very regimented set of steps, although that is important. Move to the next slide. So again, thinking big. Here are some of my bullet points as we kind of head into 2016. And again, I'll answer any questions along the way, or I'll answer them towards the end of the presentation. These are just my opinions. You may agree with them, you may not agree with them, and that's totally fine. That's what makes markets go around. What is more important is that you can have a good, open discussion about these things and hopefully learn from it, as opposed to saying, oh, you're completely wrong, that'll never happen. Well, maybe not. Let's try to be a little open-minded. And I'm not saying anybody in here isn't, but you know, I oftentimes you can get into a debate with people about the markets, and it's a very passionate thing, very ego-centered thing, or ego-centered. And sometimes people lose track. They're so desperate to hold on to their forecast that they kind of miss really valuable nuggets of information. But in my opinion, we're in uncharted waters in asset markets across the world. We've got unprecedented central bank policies, and I think unprecedented is a very kind word, and I'll let your imagination fill in any blanks you want as to what my opinion is on the central banks. Warped asset prices, usually as a result of the central bank policies. There is an underlying inflation that is going unchecked, at least in terms of the typical inflation measures like CPI, due to hedonic adjustments and various other trickery, for lack of a better word, or let's say manipulation of numbers, however you want to phrase it. We have a potential debt crisis. We saw junk bonds in 2015 basically get smoked. We're starting to see investment grade bonds take it on the chin a little bit as well, but they haven't really come under that much pressure yet. We have the Fed raising rates. Whether or not that was wise or not is open to debate, but they did raise rates. I'd be shocked if we see any more rate rises, but again, that's an opinion as opposed to, or my opinion / forecast. And once again, we can go back a mere 5 years to 2008. Sorry, 6 years now. No, take that back. 8 years. My God, 8 years, and we can even go back into 2000, and we see the same things over and over again. No history lessons have been learned. So here's where we are presently, at least, and this is now looking at this from an equity market standpoint. And trust me, I'm going to distill this all down as to give you a sense of why I'm looking at the things I'm looking at into 2016, and I'll get to that by the end of the presentation today. We've had an amazing rally since 2009, and we have not even had a 20% decline. Now, again, these are just statistical bullet points. These are not saying anything will happen. It's just saying it's statistically kind of unusual for the market to rally this long, this far without a 20% decline. We've only had three other instances: 2000, 1929, and 1956. Periods where equity weakness was seen shortly there or in the years afterward. I don't think our 2015 data point is really that far off the mark. I think that's something that needs to be factored in and taken into consideration. The other thing is that we have market cap as a percentage of nominal GDP pretty high. It's above 140%. And if you look at these red areas right here, Last time we've exceeded the 140% or got right to it, the market did experience a protracted period of weakness. Will that happen again? Possibly. But again, I'm just using a historical context here. It doesn't mean anything's going to happen today or tomorrow, but I would say the odds are increased that that could happen. We all know that over the last several years, we've had a continuing deterioration in breadth in the equity markets. For the most part, nobody's really given a hoot about it. I think that's largely because we've had the Fed at our back, and that usually kind of trumps everything else, no pun intended, given the state of US politics right now. But at some point, markets can only go up for a sustained and healthy period if you have a lot of breadth in the marketplace. We don't have that right now. That's a little troubling. This slide is a perfect example of that lack of breadth. If you took out the FANG stocks that we've all heard about, the Facebook, Amazon, Netflix, and Google, the S&Ps are not doing terribly well. So for a market to be basically pinning its hopes on 4 stocks, I don't know, that doesn't work really well for me. And of course, we no longer have quantitative easing. And if we don't have quantitative easing, it's really hard to justify the market moving higher unless the fundamentals and the valuations would warrant. But they don't at this point in time. Valuations are high. Arguably, the economy on a global basis is slowing. So by those 2 measures, those are not supportive to equity prices. And if the only other thing that's really kind of kept the market moving higher is QE, and we don't have that anymore, again, where's your underpinning demand for stocks? And what this chart clearly shows is that since QE has ended, we've basically been relatively flat compared to what we had prior to that. So based on all of this, here are some of my broad-based forecasts. I'm of the opinion that the S&Ps are likely to remain under pressure in 2016. For the last few months, and I'll get to the charts in just a moment, they've largely been sideways in the S&Ps, but I think that could change. Right now, the dollar index, I remain bullish on it, but at present, we're kind of going through kind of a corrective phase, but I believe we'll pop out of that. That will continue to see the dollar move higher. Good. Gold miners. I mean, at some point, they should begin to turn higher, but as I'll explain to you in a few moments, just because they're cheap doesn't mean that I'm buying them. And I'll explain what I mean by that in a moment. And last, the other thing that I'm looking at is tech stocks in terms of being short them. I nibbled at them a little bit in the fall with mixed results. A couple worked well, a couple didn't. But I do think that some of the tech stocks are going to be quite vulnerable into 2016. And if we see a weak S&P 500 and a weak NASDAQ, those are the ones that I'm going to want to be going after. So as you could probably tell, I try to keep my focus broad, but very targeted within that broad context. And what I mean by that is I'm looking at the S&Ps, I'm looking at the dollar, I'm looking at particular sectors that based on these things might do well, meaning I think gold could do well. I think tech stocks could be vulnerable. And then from there, I could start looking at, well, how does that fit in with the FX market? What are some themes in the FX market that might work? So we're going to touch upon those as we get going here. I'll make this comment on gold and the gold mining stocks. They've been down for 4 years in a row. So obviously they're beaten down. They could be down 5 years in a row for all I know when 2016 wraps up. But what I do know is that asset classes that are down 3 years in a row, typically, and I emphasize typically see gains of 34% in the following year. Gold miners have been down 4 years in a row. Does that make that statistic a little bit more robust? Maybe, maybe not. I'm looking at the charts in order to help me, and I'll get to those in just a moment. So I'm going to pause it right there. I'm going to pause my microphone for just a moment. I'm going to get a sip of water, and then we're going to dive into the charts and kind of show you how I'm taking all of these kind of macro themes, these broad forecasts, and kind of distilling it down into the equity market or into the charts and where I want to be making trades. So just bear with me for maybe 30 seconds and we'll resume our discussion here. Okay, I am back. The other thing I did while I was stepped away there for a moment was I changed the screen share to a different window. Is everybody now able to see a chart of the S&P 500? My mouse moving around here in the middle? If you could just confirm that, that would be great. Okay, good. Then we're in good shape here. And the slideshow over here. And as always, if you have questions along the way, please feel free to type them in. All right, perfect. So, S&P 500. To me, that's kind of the million-dollar question, because I think as the S&Ps go in 2016, it's going to drive a lot of price action in the other asset classes. What I can say in terms of the S&Ps at this juncture is that they're messy. And I think that's a given. We had that big sell-off in August. We've moved back higher. I'm not convinced that this is the beginning of, let's say, another leg higher. As you can see, obviously, too, and I've probably gotten a little ahead of myself here. I am, from a technical perspective, I am an Elliott wave guy. And I am going to be real blunt about Elliott wave analysis. I know a lot of people kind of roll their eyes and think it's voodoo and whatever. I could make the same assertion about any other analysis style out there. I think what people get hung up on is the so-called subjectivity of Elliott wave analysis. And I would disagree with that on some level. Once you understand the fundamentals of it, which are very objective and easy to understand, yes, they take a little time, but anything in life that's worthwhile takes time. It really does allow you to put a framework around price action with objective rules. What I am not in terms of Elliott wave is a purist or a hard ass about how people do their counts. There are rules that need to be followed, but by and large, what I tend to do is my wave counts match the trends of the market. I'm never trying to impose my view of the market into a wave count. And what I mean by that is as follows. Let's get rid of the S&Ps right here in terms of the price data prior to August. And let's say we had no idea what was going to be happening on June 27th, because the last bar I'm showing here is June 26th. I am not going to be putting a wave count together here that is making a major bearish call, because the trend is clearly up. I'm not smart enough, nor are most people smart enough, to routinely pick tops and bottoms. There is an Elliott wave service out there that is notoriously bearish. They've been bearish since I've been around, as opposed to just simply letting the market direction dictate their wave count. They've got it flipped around. I can't figure that out for the life of me. Why make your job harder than it needs to be? So if you know that, the trend is up, put together a wave count that's in harmony with that. Maybe it's wrong. but more likely than not, it's going to be right because you're aligning yourself with the trend of the market. So what I think we have going on in the S&Ps, I'm going to put a weekly chart out here, is obviously we've had this, massive run up off the 2011 lows and even going back into the 2009 lows. But what I think we're getting right here is at minimum, a correction to the downside. Now, many people might say that this pullback right here was the completion of wave 4. That's possible. That's not my view on the market. I think we're going to head down in one more leg lower that could take us down to around 1800. And then from there, if that scenario plays out, I'll reevaluate what I want to do. Was this just a correction that completed down here? Or was this, in fact, this high back here, the actual top of a multi-year bull market? I don't know the answer to that yet. So what I'm doing here is I'm taking the least bearish view. I'm not going to get super bearish in here because technically the market's still in an uptrend and it is just merely correcting at this point in time. But even if I take the view of it just being a correction, which would be bearish, I'm still going to get the benefit of taking advantage of that downside price action. It's a question now of, in my opinion, how far or how low we do go. Do we just go down to this 1807 area, which is what my price forecast is, somewhere around into the middle of February? I don't know. But if we get down here and the wave structure looks overly bearish, or we break through this low right here and then we make, much deeper lows, I can always go back and reevaluate it. Doesn't mean that I'm wrong. I still took advantage of the move to the downside. I'm just not getting too wide-eyed about it. So the bottom line is, I think we're heading lower in the weeks ahead. That's my forecast. I could be wrong. I happen to be short the S&Ps vis-a-vis the SPY and vis-a-vis an option put spread. And I'm looking out into February where I think that can happen. I think we can get down into the 1800s, give or take. Ideally, we'll get down to around 1807. That could happen. I think there's a strong likelihood that will happen. If I'm wrong, I'm wrong. But I don't see this move off the lows, which is why I can't really call this the end of wave 4. This is not an impulsive move. Then again, neither is this move to the downside. So what I think it is just a very complex correction that will ultimately still provide lower levels. So that's my theme in terms of the S&Ps. That's kind of how I see it playing out in the weeks and days ahead. The next big asset class that I'm always looking at, of course, is the dollar index. And here too, I know there's a lot of busyness on the charts here. So why don't I do us all a little bit of a favor here and just take out some of those waves so that it's easier to see. And to me, we have a very clear move higher out of this correction into the August 24th lows. And I believe we're in the midst of starting another leg higher in wave 3 that should take us up to, at minimum, 104, maybe up towards 108. That's what I think is going to happen during 2016. If we could take out this high right here at 100.56, that adds more fuel to my argument. But right now, there's no reason for me to be bearish the dollar index. I don't see any reason why you'd want to be bearish. The trend is up. The big impulsive candles are always to the upside, not to the downside, generally speaking. So again, why fight the trend? So that means we probably, if the dollar index, and I'm going to throw this out there just as a question to make sure everybody's paying attention. If we're bullish and you agree with my forecast for a stronger dollar index or a higher dollar index, what type of a position would you want to have in the euro? And if you could just type those answers in, I'm just real curious. All right, there we go. Everybody can hear me again? Okay, perfect. Well, the answer I was looking for was given to me by the participants here, and the answer is you'd want to be short the euro. You certainly don't want to be long the euro if you're bullish the dollar index. It's an inverse correlation. It's really, really simple. So that's one thing that, you know, if you're a new trader and you're looking to get long the euro, you better make sure that your dollar index is about to go lower at the same time. But one of the things that was noted in the answer that I received was you want to be short the euro, but from where? Again, that's a very open-ended question. Depends on your time frame. Are you looking out to the end of 2016? And if you're going to be bearish the euro, who really cares where you get short from? Right here would be just fine. If you're only going to be looking to be short the euro for the next day, well, then your entry is really far more important. You've got to finagle it so that prices don't go against you too much. So I can't answer that question because there's no one size fits all answer. It depends on how long you intend to hold the position for. But that's okay, because again, if you keep the big picture in mind, means you're always going to be wanting to favor short positions in the euro as long as the dollar index is maintaining an upward bias and as long as the euro is maintaining a downward bias. And again, here's my technical chart for the euro. To me, I would say at this juncture, it would be a wide stop if you were going to be looking to, you know, just short in general. I'd say anything above, let's call it 110, would be invalid. And then definitely if you got above 110.91 or call it 111. But as the way I see it out, as the way I see it playing out, I think we're heading down towards 105.75 and then lower. And that's just in the early part of the year. And this, of course, assumes that the dollar index maintains its move higher as well. If we go to, let's say, a shorter term time frame, which I know a lot of people tend to play, I'm going to put it in an hourly chart. You know, I would say, based on the way I read this chart, this is not something I'd be shorting right this moment. I'll be waiting for prices to rally a little bit. We have an oversold stochastic, which if you look back after spikes lower and spikes higher, overbought and oversold does tend to lead to sell-offs, rallies, sell-off, rally. So this is probably not the most ideal spot to be getting short the euro if your time frame is of limited nature and you're going to want to keep a tight stop. So, you know, I could count this 1, 2, 3. Yeah, I mean, probably going to be selling rallies. And again, depending on where your time frame is, is where you're going to want to get short. Now, the other one that I think is quite interesting is dollar Swiss. If we're bullish the dollar index, we should be bullish dollar Swiss. And if you look at the chart here, bring the labels back so you can see it. I'm bullish the Swiss. I'd like to be a buyer of a pullback into this Fibonacci level because we've rallied in 5 waves. Stochastic's a little overbought. I'd like to possibly buy some sort of a pullback here. Now these are near-term trades. These aren't trades necessarily that could last throughout 2016, but certainly they could. But again, I'm usually looking at trades myself that are going to go out several days, maybe a week at the most or so. So for me to be buying a pullback in dollar Swiss would be ideal. I mean, it, to me, seems pretty clear that the trend is higher. And after a pullback, and assuming we don't break below 98.57, this move should continue higher. Now, the other asset class that I'm looking at, and I mentioned, I'm going to kind of start wrapping this up and get to some Q&A, is gold. Again, gold has been kicked in the teeth for God knows how long now. 4 years? Yeah, 4 years. Is this the beginning stages of a rally? I don't know. It's really hard to say. Technically, I could say that we still have further to go. I mean, theoretically, we could head down towards 90 in GLD, which is an ETF proxy for gold. But as it is right now, the price action is somewhat encouraging. It's moving sideways. And I think if we were to break above, let's say, the 104.25 level, at minimum, we might scoot up to 106. So there might be a trade there based on Elliott wave. And I'd be willing to take that trade because it is entirely possible that this is the early stage of a bottoming in gold. Therefore, I'm willing to go into this as a trade thinking, okay, I'll sell it up around 106. But if something more robust or the sentiment and the tone in the market changes where people are embracing gold as opposed to ridiculing it, then my entry is actually quite good and I can look to build that position from there. You can do that through options. You can do that through being long GLD, or you can do that through long futures contracts. So the only other thing that I'm looking at, and I don't mean to be kind of cramming this all in at the end, but we do have a time frame, time schedule here, and we'll get to more of this stuff each week. We'll get into more detailed chart analysis and more about what's happening in the market. But for today, I wanted to kind of share with you how I see 2016 unfolding, and then give you kind of a big picture technical view of where I see those themes playing out in terms of price action. The other stock that I'm really keen on, and I'm on the short side, that is Intel. I think that their overall business has a lot of problems, simply because microprocessors and the whole desktop PC market is something that is basically dying. I mean, it's dying a slow death. People are using their mobile phones and whatnot. And I just don't think that business model is quite as robust as it's been. And as a result, this is a stock that's probably way overvalued relative to what its actual business is. But in a market where you have quantitative easing and, rampant speculation, even pigs fly. And to me, Intel is a stock that I think could be really crushed hard in 2016. I have not done anything with it just yet, but I'm starting to get interested as it starts breaking some of these support levels. And obviously, depending on how the S&Ps do, I'll be looking to do that as well. I will more than likely short Intel via some sort of a put spread in the options market or an outright put. I probably won't do anything in the underlying stock. And I might do slightly longer dated. I might be maybe doing October option positions there, because I think this is something that could be sustaining in terms of the downside pressure throughout 2016. So with that said, I guess we need to get to the Q&A. First of all, I appreciate everybody coming by. I hope we have a good, robust Q&A session. And the other thing too is that this is just the first series, or the first in a series of live broadcasts that I'll be doing. And my main goal today was simply to provide an overview, not get into a lot of the details. We'll save that for the ongoing. I want to make sure we get off on a good foot, give you a sense of who I am, how I look at the markets, and then we'll start getting into the more of the technicals and looking at some setups that might be evolving over the next day or two after we do our broadcasts. So let's get a few questions in there if we could. And after we do that, I'll wrap it up and pass the torch to the next presenter. I'm not sure who's presenting next, but I'm sure there'll be another jam-packed information session. So type in your questions into the chat box. Hopefully you have some. If you don't have any, then I'm going to either wonder that I've been incredibly clear and nobody has any questions, or nobody really gave a hoot about what I talked about. So hopefully we get some questions. Gabriel has just a comment in here. Nice, clean stuff. Many thanks. You're more than welcome. I appreciate that. I've never been accused of being unclear in my presentations. I think I'm a pretty good and pretty succinct presenter. Carlos had a question. Do you believe the euro reaction to QE will be similar to how the US dollar behaved during QE here? And I'm assuming, Carlos, what you mean is, will the euro continue to weaken as ECB continues QE? If you can just confirm that so I make sure I'm answering your question properly. Okay, I need a little bit more clarification, Carlos. I think I understand your question, but to me, it's not specific in terms of what you're asking. Sorry to. I think what we need to keep in mind in terms of the euro, in terms of the euro, since that's your specific question here, and let me just clean up this chart a little bit here so that it's easier for you to see everything. What Carlos is saying here is that when QE was happening here in the US, the dollar was range bound at times. And let's bring up a dollar index chart. And the answer, and I'm assuming you're referring to this period in here, Carlos, because prior to that, it was pretty obvious that the dollar was moving higher. So that's clearly not ranging. Again, this is speculation, and it's easy to do after the fact. This is by and large a function of two things. One, the technical position. After a 5-wave up move or down move, you usually get a sideways or a downward correction, which we got. This is also a period, though, when we didn't know when the Fed, what they were going to do. They were so clueless and still remain so clueless that they kept pushing it out. It's data dependent. It's this, it's that. They had no idea. And I think the market knew that on some level. And as a result, if you get a market that is relying upon the Fed, which I think is a big mistake, but I won't let my opinion shine through too much. If you get the Fed, or if you get the market not sure about what the Fed is going to do, and that's what they're using as their anchor, as their catalyst, you're going to get this type of price action, lethargic and pathetic. Once there was some clarity on when rates would be raised, the dollar resumed its uptrend. I think the same thing will be true of the euro. It's all going to depend on how the ECB handles it. They're in the same mess that the Fed is in. It's a question of how they handle it. So I can't answer that as to what they will do, meaning the ECB. But if I look at the chart, at least for the time being, there is no evidence of sideways chop. You know, the market's clearly moving lower, and it looks as though it's about to resume that path lower. So I would say, unless the ECB starts giving some confused signals, it seems as though the lower euro, higher dollar dynamic will stay in place for the time being. Mike had a question in terms of how many pairs do I trade and do I average down on my trades? I probably keep an eye on about 10 currency pairs. I'm pretty dialed into probably about 5 or 6 of those. So I keep my universe pretty small. I think that's important because I think, like anything in life, minutia and detail can really help you see and uncover things. And I mainly trade the G10s and a few crosses, so nothing crazy, nothing exotic. Do I average down? Not really. Do I like to buy pullbacks and uptrends and sell rallies and downtrends? Yes. If I get filled and the prices continue to go against me, do I add to it? Typically not. Because I'm a believer that I don't like to try to pick tops and bottoms. I usually like to let the market respect a support level that I've identified or a resistance level. And then if it reacts positively to that, then I'll look to hitch my wagon to the resumption of that trend. So by default, I don't average down. I mean, maybe I do a couple, 3 times a year in an unusual situation, but I'm never buying, let's say, take the euro, for example. I'm not shorting it at 107.42. And then if it rallies back to here, I'm not selling at 109.31. The only time I'll add to a position is once it's established that it wants to move in the direction that I've forecast in advance. Got a question here. If the S&P is to be declining, would you get out of the market and move into cash? The answer is I've already been in cash since middle of last year. I've been dabbling with puts and short positions from time to time. To me, the S&Ps in here are a low reward, high risk scenario, basically picking up nickels in front of a steamroller. So for anybody out there that's on this call and happens to be, let's say, a quote unquote wealth advisor and has their clients fully invested at this point in time, let me know how that works out for you. And I don't mean any disrespect, but I've kind of got some problems with the wealth management industry. It's atrocious how it's run. I do have managed accounts to the second part of your question, but the managed accounts are only in the FX market. I don't do any managed accounts in the equity and or option space, but maybe down the road that might change. But right now, just in the FX space. But to answer your question, I am neutral to bearish the S&Ps. Therefore, in my personal accounts, I do not have any long equity positions. I do have some long gold positions, very small. And I do have a put position currently on the S&P 500. And I've also recommended that to my clients on the research side. So that's my take on the S&Ps. I think if you're fully long the S&Ps in here, maybe you're right. Just let me know how that works out. Mike says, picking up nickels, that explains my trading. Well, we've all been there, Mike. And I think what I would say to you is that I think our tendency to want to pick up nickels but risk dollars is because maybe we don't know why we're making a trade and we don't have confidence in what our trade setup is. That's why I said at the beginning of the presentation, if you stand for nothing, you'll fall for anything. That applies to trading. If you get long the euro, let's say here, and you can't really articulate to me why you're long the euro in 20 seconds or less, you probably shouldn't be in the trade. You got to know why. Because if the trade starts to go against you and you have nothing to fall back on, then you go into reaction mode. The reptilian brain takes over and you're not going to manage that position very well. Same, even if the trade started to work out for you. You still don't know why you're in the trade, yet it's working. You're probably not going to maximize your exit. And I'm not saying I'm perfect at this. Managing winning positions is the hardest thing in the world. But if you know why you're short from a technical and a fundamental standpoint, let's say, and prices are kind of working against you a little bit, but nothing crazy, you can look at that and go, okay, market's not, reacting to the way I thought it was yet. And on that note, I've got to wrap it up. It's the top of the hour. I greatly appreciate everybody's time. I will be back next Tuesday. And what I will encourage everybody to do if they want, I'm going to put a link in here. Anybody wants to take a trial to any of the services that we offer, you're more than welcome to. 30 days for $1. I just put the link in there. And it might be a good way for you to take a look at what I do on a day-to-day basis for my clients. And then when we're talking again next Tuesday at 11 a.m. Eastern, 4 p.m. Greenwich time, you'll kind of have a little bit of perspective. But again, I thank everybody for taking the time out of their day. I hope it was helpful for everyone. And we will see you folks next Tuesday. Have a great week of trading and take care.